Good morning, afternoon, or evening to all of our investors from wherever you're watching. For those who joined us at the start of this year for our 23 outlook, this is our update and review of the key observations. These help us understand the drivers and the logic for the markets and allows us to frame our asset allocation and selection. The presentation is in three parts. A, what we expected this year. B, what has actually transpired in the first half. And lastly, C, how do we expect 2023 to close? At the start of this year, we set out 5 expectations that we thought would be the most important factors to define the investment environment. To recap, these were: number 1, inflation would be persistent. Inflation would become the key driver for economic policies and therefore would preoccupy markets. Our perspective is inflation in 23 is both monetary and fiscal in nature, and unraveling this is a slow process because there was a large amount of stimulus provided into the monetary system to fight COVID. To give you some perspective, it was some 10 times larger than the GFC stimulus. That is an unprecedented amount of liquidity that's been injected directly into the accounts of individuals, as well as the financial system and commercial enterprises globally. At the same time, the global economy was reorganizing, rebuilding, and reorienting its supply chains, creating both supply and logistical mismatches. Goods and logistics are inherently a physical activity, and one problem that a central bank can't just print away. It'll take time to achieve new balance in supply. Number 2, central banks must fight inflation. Inflation affects all prices. It adds cost to production and services and adversely affects everyone. Central banks would need to address inflation, and the only tools they have available are monetary policies. That is, raising rates and/or restricting the availability of money, liquidity. Given the amount of money that was actually injected into the economies, we believe that the following is unavoidably true. A, the speed and amount of expected interest rate rises would be proportional to the amount of liquidity injected. B, it is easy to inject liquidity and very difficult to withdraw it. Consumers, businesses, and even government instrumentalities will have made commitments for these funds, and this withdrawal will be unwelcome and difficult. Taken together, we can expect interest rates to rise quickly and steadily. Number 3, in line with the thinking that inflation would be persistent and that interest rates will rise, it follows that we should not expect rate cuts. Therefore, rates will remain at higher levels. Importantly, interest rates at close to zero or less was an emergency measure and outside the bounds of what we would consider normal policy. In fact, at or near zero, the central bank has no monetary policy. These emergency rate cuts were instituted as a measure during the GFC and continued for about 15 years. Therefore, we continue to expect the re-establishment of higher rates. Number 4, economic activity will slow. Aggressively raising rates in an environment of persistent inflation is a policy that is designed to slow down demand and the economy. However, when we add expectations of investors, consumers, and businesses that have been developed in the last 15 years, we can expect that the slowing is moderated by an expectation that the central bank will not want to crash the economy. This expectation is expressed in Australia as a persistent faith in property, and in the US as a desire for the Fed to pivot. We would think that there's going to be disappointment when there is no pivot on rates and the property market no longer has the buoyancy it once did. Our expectation is that this will be painful and confusing, but this policy will persist. Consequently, we would expect an economic slowdown that leads to a reduction in corporate earnings, and that could possibly lead to a recession. And even if it doesn't meet the official criteria for a recession, nobody is going to enjoy this experience. Number 5, and lastly, we expect divergence. We expect that the increasing interest rates and decelerating economy will unfold differently in each country and region. Although there'll be similarities in some of this, it's the differences that will matter the most. It follows that the central banks will be led by domestic interests, and this will lead to a divergence in their policies regarding direction, size, and timing of monetary policy. With these markers on our investment horizon, we have weighted our portfolio towards capital preservation and seeking opportunities that are uncorrelated. How has the first half unfolded? Time has unfolded in several events, such as the changing tide of war that plays out in Ukraine, a US regional bank crisis, liquidity crisis in UK gilts, and increasing stress on mortgages and in commercial real estate. But let's not be distracted by events. The focus should be on the message of the underlying trends. Is inflation persistent? Well, it depends. It depends on where you are, but we can generalize that. Inflation in developed Western economies is persistently higher, and it's certainly at levels above the 2% target. However, when we examine China and Japan, we see a diametrically different picture. Admirably low levels of inflation. This sets the stage for the BOJ and the PBOC to diverge from the lead that's been set by the US Fed, where we can see that the BOJ and PBOC are both accommodative and stimulative of their economies to deal with growth and currency issues more so than inflation. The first half has seen continued rate rises. This is again true in developed Western economies, where rates have risen and remain persistently high. Recently, we've seen a pause from the RBA and US Fed, respectively, though we'd note that in the same time frame we see large increases by the BOE and ECB. That's divergence in central bank policy. Interest rate rises, like we've seen in inflation, China and Japan have different conditions, and they've not tightened. Whilst we're observing the cash rate, we should note that the Chinese prime lending rate has been reduced, which is clearly stimulative. Japan has maintained a policy of yield curve control, where the 10-year JGB is capped. While this maintains a stimulative interest rate, it's done so at the expense of a depreciating yen. Growth is slowing, or has already slowed. Since the start of 2023, it's clearly observable that growth in Australia, US, UK, and Europe is slowing. When we graph the GDP statistics, UK and Germany are in a recession. And in our opinion, it is only just a matter of reporting for the remainder of Western Europe. In Northern Europe, there is a serious land war with Russia, where neither side has made any significant progress in offensive or counter-offensive. The impact of slowed growth in this region extends well beyond its borders, as it's already forced a higher allocation of GDP to defense and will affect soft commodities such as wheat. China and Japan, again, stand out as different, with economies that have already slowed. In late January, the investing world looked towards the promise of a China reopening to repeat the stimulative effects we experienced post-GFC. The effects were slow, and there was a period where there was some promise in the pickup to the Chinese export statistic. However, at this moment, we would have to conclude that the China reopening has not delivered the growth impetus that we had all wanted. It's not the disappointment that's concerning, it's the worry that maybe there's a structural issue at play that cannot be resolved by a quick change in policy. The drivers and logic of markets have largely unfolded as expected, with one exception. We had expected slowing growth to the point of a recession, or And even if it's not declared a recession, it will be painful. What we actually see is parts of the world have persistent inflation and slowing growth, and other parts slowed to recession or very nearly. We would not think of this as a global recession, but it sure is painful. Nonetheless, for us, our weighting has been towards capital preservation and the pursuit of uncorrelated assets. And this has resulted in no defaults, no impairments or distressed assets, and the maintenance of a consistent performance and income stream. For us, we must now consider, how do we close the year? Firstly, we think that central banks have pretty much done all they can with monetary controls, that is, interest rates and quantitative tightening. Although this policy will continue, and we may see small rises in interest rates in the future, to further reduce inflation, we will need to address the fiscal aspect. That is, how we spend. This is a question of how governments spend, that is, fiscal policy. The implication is that we should anticipate a reduction in overall spending and a focus on priorities. Second, and thirdly, we're not expecting rate cuts in 2023 in any of the developed Western economies. Stimulus is more likely to come from direct spending and legislative or policy changes, rather than further monetary intervention. This will have macro implications to play out over 2024 and beyond. It follows that if we don't expect rate cuts and that fiscal policy comes to the forefront, then rates will remain higher for as long as it takes to address inflation and its underlying structural issues. Fiscal policy will always be domestic, and would suggest that in all instances, governments must address their level of debt. In an investment environment where not only rates remain higher for longer, but national budgets also become more restrictive, we'd say we're not returning to any semblance of a pre-COVID economy. Fourth, into the close of 23, we'll all understand that increasing growth is as difficult a problem as decreasing inflation. It would be difficult to imagine that we can address inflation without dampening demand, and we probably will continue to slow down. However, we would no longer expect a global recession. Also, we would not be too optimistic to say we expect no recession. The slowdown is very domestic, the recession will be regional. This is an improvement in the expected risks. As growth becomes the predominant issue, we no longer expect a divergence in central bank policy. Emphasis will change to fiscal policy, and as mentioned, this is driven by domestic matters as each economy concentrates on their domestic growth concerns. The tools to implement fiscal policies are much more nuanced and include taxes and incentives for domestic industries, controls on free trade, which includes tariffs and quotas, trade agreements, capital controls, and such like. These are matters of policy and therefore necessarily of politics. The effect we expect is the emergence of more geopolitical issues. It's a transition. Growth will increasingly replace inflation as the issue of the day, and there is a greater divergence in economies where each will focus on their domestic issues. The monetary and fiscal policies that will be needed will reduce liquidity and credit. This is likely to increase the ROI required for riskier ventures, perhaps to the point where they are no longer viable. True to say that the risks have moderated, or at least clarified themselves since the start of the year. And it's this clarity that helps us weigh our choices towards quality. That is, safety and liquidity, with an increased interest on our side for uncorrelated assets in the second half of 2023. That brings us to the end of our review, and again, I thank you.